Something moved in the silver market that was not supposed to move, not this fast, not with this kind of volume, and not in a way that suggests coordination. But it happened anyway. Over the last several days, the commercial short position in silver futures expanded by a margin that historically appears only during moments of acute pressure. The kind of pressure that comes when physical delivery becomes more than a theoretical problem. The kind that forces institutions into defensive positioning, and the timing lines up with something specific, the Bloomberg Commodity Index rebalance. Every year, this rebalance redistributes billions of dollars across commodity weightings. Silver's weight in the index was adjusted downward. That adjustment triggered automatic selling. Roughly $6 billion in notional exposure had to be unwound or redistributed. That is not a small number. That is the kind of flow that moves markets, and it moved silver. But here is what makes this different. The selling was not absorbed quietly. It was absorbed by a market already under strain, a market where premiums on physical silver have been elevated for months, where refinery delays are measured in weeks, not days, where mints are rationing product, where the spread between paper price and physical delivery price has widened to levels that should not exist in a functioning market. The narrative being pushed is simple. The rebalance caused a temporary dip. Markets corrected. Nothing to see. Move on. But that narrative ignores what happened immediately after. The short position did not decrease. It increased, aggressively, and it increased at a time when physical demand has not softened. It increased while premiums stayed elevated. It increased while inventory data from London and New York showed continued drawdowns. That is not normal selling. That is not rebalancing. That is suppression, and it is being done in the open. The commercial traders, the ones holding the largest short positions, are not speculators. They are banks. They are institutions with access to central bank liquidity. They are the entities that facilitate the flow of paper contracts that determine the price of silver on exchanges like COMEX. And right now they are short silver at levels that suggest they are either supremely confident in their ability to deliver metal, or they are desperately hoping demand breaks before they have to. The problem is demand is not breaking. It is accelerating, and it is accelerating in places where it cannot be easily tracked. China has been buying silver quietly for over a year. Not through headlines, not through official announcements, but through import data, through refinery orders, through the steady, relentless accumulation of physical metal. And China does not buy silver for speculation. China buys silver for industrial use, for solar panels, for electronics, for infrastructure, for strategic reserves. And once that metal crosses into China, it does not come back. India is also buying. India has always bought silver, but the volume has increased. The cultural demand for physical metal during wedding seasons and festivals has not changed. But now it is layered on top of industrial demand that was not there a decade ago. India is not a market that sells back into global supply. It is a market that absorbs and holds. Mexico, the largest producer of silver in the world, is seeing export volumes decline even as production remains stable. That metal is being consumed domestically or redirected. The flow that used to feed European and North American refineries is not flowing the same way anymore. And then there is the United States. The United States Mint has been rationing Silver Eagles for months. Rationing. Not because of a lack of blanks, not because of staffing, but because the blanks themselves are not arriving in sufficient quantity. The refineries that supply those blanks are prioritizing contracts, and those contracts are not going to retail investors. They are going to industrial users. They are going to entities that buy in tonnage, not in tubes. This is not a shortage in the traditional sense. There is silver, but it is not where it needs to be, and it is not moving the way it used to. The supply chain has fractured, and the fracture is not being repaired. It is widening. Meanwhile, the futures market continues to operate as if none of this matters, as if the paper contracts being traded have no connection to the physical metal they are supposed to represent, as if the shorts being piled on by commercial traders will never have to be covered, as if delivery will never be demanded. But delivery is being demanded, not in large publicized events, but in steady, grinding pressure. Every month, more contracts stand for delivery than the month before. Every month, the inventories at COMEX and LBMA tick downward. Every month, the spread between futures price and physical premium widens just a little more. And every month, the banks add more shorts. This is not a sustainable structure. This is a market being held together by the assumption that demand will ease, that China will stop buying, that industrial users will find substitutes, that retail investors will lose interest, that the price will stay low enough, long enough, for the shorts to be covered without triggering a cascade. But what if that assumption is wrong? What if China does not stop? What if industrial demand continues to grow as the energy transition accelerates? What if refineries cannot increase output fast enough to meet both industrial and investment demand? What if the premiums on physical metal rise to a point where futures price becomes irrelevant? Then the shorts are trapped, and the banks holding those shorts are trapped with them. The Bloomberg Commodity Index rebalance provided cover. It provided a narrative. It allowed the commercial traders to add billions in short exposure without raising alarms. It allowed the price to be pushed lower without immediate scrutiny. It created the appearance of a technical move rather than a structural one. But the rebalance is over. The selling tied to the index adjustment is complete. And the shorts are still there, larger than before, heavier than before, and the physical market has not loosened. If anything, it has tightened. The premiums have not come down. The refinery delays have not shortened. The mint rationing has not ended. The Chinese imports have not slowed. The COMEX inventories have not rebuilt. None of the conditions that would justify confidence in the short position have materialized. And yet the shorts remain, growing. This is not strategy. This is desperation masked as control. The mechanics of the futures market allow for this. As long as contracts are rolled forward, as long as cash settlements are accepted, as long as physical delivery is not demanded in mass, the structure holds. The price can be managed, the shorts can be maintained, the system can continue, but the moment physical delivery is demanded in volume, the system breaks. Because the metal is not there, not in the quantities required, not in the locations required, not at the prices being quoted, and the entities that would demand delivery are not retail investors. Retail investors do not have access to COMEX. Retail investors do not deal in 100-ounce bars. Retail investors are not the risk. The risk is the industrial users who cannot afford supply disruption. The risk is the foreign central banks that are quietly diversifying reserves. The risk is the sovereign wealth funds that are moving into hard assets. The risk is the entities that have the capital, the access, and the need to take delivery in size. And those entities are watching. They are calculating. They are waiting for the moment when the cost of waiting exceeds the cost of acting. That moment may not be here yet, but it is closer than it was. The silver market has always been small relative to gold, small relative to oil, small relative to copper. That smallness has made it easy to manage, easy to manipulate, easy to suppress. But that smallness also makes it fragile. It does not take much flow to move the price. It does not take much demand to overwhelm supply. It does not take much pressure to break the structure. And right now, the pressure is building. The $6 billion rebalance was not the cause. It was the trigger. It exposed the fragility. It forced the banks to reveal their hand. It showed that they are willing to add shorts into a market that is already under strain, that they are willing to bet against physical demand that has not relented, that they are willing to risk delivery obligations that may not be possible to fulfill. This is not confidence. This is a gamble. And it is a gamble being made with leveraged positions in a market where leverage breaks suddenly. The narrative that this was a temporary dip, a technical correction, a non-event, is being broadcast loudly. Across financial media, across analyst reports, across the same institutions that are short, that narrative serves a purpose. It discourages buying, it encourages complacency. It maintains the illusion that the paper price reflects reality. But the physical market is telling a different story, and that story is not being broadcast. It is being whispered. In refinery delays, in premium spreads, in inventory drawdowns, in import data, in rationing, in the quiet accumulation happening outside the Western financial system. The disconnect between paper and physical has existed for years, but it has always been manageable. It has always been narrow enough to ignore. It has always been temporary enough to dismiss. But that disconnect is no longer narrow, and it is no longer temporary. It is structural. And it is widening. The banks are aware of this. They have to be. They have access to the same data. They have access to better data. They know the inventory levels. They know the refinery capacity. They know the delivery schedules. They know the flow of metal, and they are still adding shorts. That means they believe they can manage this, that they believe demand will break before supply does, that they believe the price can be held low enough, long enough to outlast the pressure, that they believe the physical buyers will capitulate before the shorts have to be covered. But belief is not reality. And the physical market does not care about belief. Silver is not a financial asset first. It is an industrial metal first. It is used in solar panels at a rate of nearly 150 million ounces per year. It is used in electronics, in batteries, in medical devices, in water purification, in mirrors, in conductors. It is used in applications where there is no substitute, where performance depends on the unique properties of silver, where cost is secondary to function. And the industries that depend on silver are not slowing down. They are accelerating. The energy transition is accelerating. The electrification of transportation is accelerating. The deployment of solar capacity is accelerating. The demand for silver from industrial users is not discretionary. It is structural, and it is growing. At the same time, investment demand has returned, not in the frenzy of previous cycles, but in the steady, consistent accumulation that suggests long-term positioning. Retail buyers are purchasing coins and bars at premiums that often exceed 10% above spot. Institutional buyers are acquiring allocated metal in vaults. Funds are rebuilding positions that were liquidated during previous corrections. This is not speculative demand. This is defensive demand. And defensive demand does not evaporate when price dips. It increases. The combination of industrial demand that cannot be reduced and investment demand that will not be shaken creates a floor that is rising, a floor that is approaching the paper price being defended by the commercial shorts. And when that floor meets resistance, something will break. The banks holding the short positions are not unaware of this dynamic. They are attempting to manage it. They are attempting to suppress price long enough for either supply to increase or demand to weaken. But supply is not increasing fast enough. New mines take years to develop. Existing mines are producing at capacity. Recycling provides only a fraction of demand, and demand is not weakening. It is growing. The math does not work. The position does not work. The strategy does not work. But the position remains, and the shorts keep growing. This is the behavior of entities that are either certain they can outlast the market or certain they cannot afford to exit. Neither scenario suggests stability. Both suggest vulnerability. The rebalance gave them cover to add exposure, but the cover is gone. The selling pressure from index reallocation is complete, and now the shorts are exposed, naked, visible, measurable, and larger than they should be in a market with tightening supply and rising demand. What happens next is not predictable in timing, but it is predictable in structure. Either the physical buyers relent or the shorts cover. Either demand softens or supply breaks. Either the paper market reasserts control or the physical market takes over. And the physical market has momentum, quiet momentum, but momentum nonetheless. The silver that is being accumulated in China is not coming back. The silver being consumed in solar panels is not coming back. The silver being bought by investors in allocated vaults is not coming back. The supply available to the futures market is shrinking, and the shorts tied to that futures market are growing. This is not sustainable, this is not stable, this is a structure under pressure, and the pressure is not easing, it is building. The banks may believe they have control, they may believe they have liquidity, they may believe they have time, but control is not the same as stability. Liquidity is not the same as supply, and time is running out. The rebalance was the catalyst, but the catalyst is not the cause. The cause is structural. The cause is the divergence between a paper market that assumes infinite liquidity and a physical market that operates under the constraint of finite supply. And in every market where that divergence has grown too wide, the resolution has been violent. The silver market is approaching that threshold. Maybe it crosses tomorrow. Maybe it crosses in weeks. Maybe it takes months. But it is approaching. And the entities positioned on the wrong side of that threshold are adding exposure, not reducing it. That is not the behavior of confidence. That is the behavior of entities that have no choice. Entities that are too deep to exit without triggering the very event they are trying to prevent. Entities that are trapped by their own positioning. And when trapped entities are forced to act, they do not act calmly. They act desperately. And desperate action in a market this small, this leveraged, this fragile does not resolve quietly. The rebalance has passed. The narrative has been delivered. The price has been pushed lower. The shorts have been added. And the physical market has not blinked. It has not sold. It has not panicked. It has not capitulated. It has absorbed the selling. It has held the premiums. It has continued accumulating. And that is the signal, not the noise of the rebalance, not the headlines about corrections, not the reassurances from analysts. The signal is in the physical market, and the physical market is saying something very different than the paper market. It is saying the metal is not where it needs to be. It is saying the supply is not sufficient. It is saying the price is not real. And it is saying the structure is breaking, slowly, quietly, but breaking. And the banks holding billions in short exposure are standing directly in the path of that break.